You know, usually when we sit down to map out the global financial system, we're looking for trends that line up. We want a clean narrative.
A straight line.
Exactly. But right now, if you actually look at the data and, really dig into the source material we've got for this deep dive, you see this massive, staggering contradiction.
It's a paradox,
Yeah.
honestly. It's the kind of thing that forces you to throw out the old macroeconomics textbooks.
Because on one side, you've got this deafening roar of headlines. You see it every single day. The death of the dollar.
Oh, yeah?
The BRICS nations are building their own thing. The geopolitical order is fracturing, and everyone is supposedly dumping the greenback to escape U.S. hegemony. That's the political story.
That's the op-ed narrative for sure.
But then you look at the actual on-the-ground data in the economies that are, really struggling, places like Argentina, and you see the exact opposite.
You see people adopting the U.S. dollar faster than ever before.
Faster than ever. And this is the key, they aren't doing it the old way.
Right. They're not lining up at brick-and-mortar banks to stuff bundles of cash in a safe deposit box. They are dollarizing digitally. And that distinction, that one detail, changes everything.
And that's really the mission for us today. We're going to ignore the Twitter rhetoric, the political posturing, and just look at a specific stack of reports from late 2025 and early 2026. We've got on-chain data from Chainalysis, some heavy-hitting geopolitical papers from the Carnegie Endowment and the Atlantic Council, plus financial filings from Bloomberg and Reuters.
And we're going to explore how the world is escaping traditional U.S. financial control, not by rejecting the system, but by building what these reports call parallel rails.
We've broken this down into 3 laboratories of change. First, the grassroots lab in Argentina.
Then the institutional lab in the UAE.
And then the big one, the geopolitical battlefield. The war over the actual plumbing of global money between the U.S. and China.
It's a plumbing war. Sounds boring, but it's everything.
Let's start with the grassroots. Argentina. I feel like Argentina is always the main character in these financial dramas.
It's the perfect stress test. I mean, you have a sophisticated economy, a historically educated population, but it's been just absolutely battered by monetary mismanagement for decades.
The numbers in these reports are terrifying. Inflation hit 211% annually before President Milei came in with his shock therapy.
Right.
Now, the data from late 2025 shows inflation is down to about 2.1% monthly. On paper, that sounds like a success, but the sources all suggest the psychological damage is, well, it's already done.
That's the key context. You have to remember, the Corralito from the early 2000s, the government literally froze bank accounts.
People couldn't get their own money out.
To buy food, to pay rent. That trauma is generational. It doesn't just go away because inflation dips for a few quarters.
Yeah.
So even if the economy is stabilizing, Argentines just do not trust local banks with their life savings.
Which leads to a statistic that absolutely blew my mind when I read it. Argentines hold an estimated $200 billion.
In physical cash.
In physical cash under the mattress.
It is the second highest amount of physical U.S. dollars in the world, outside of the United States itself. I mean, just think about the logistics of that for a second.
But holding physical cash is a nightmare. It's a huge security risk. You can get robbed. It degrades. And you can't use it in a modern economy. You can't pay your Netflix bill with a wad of cash under your bed.
Exactly. Or try buying a car with a backpack full of bills. It's dangerous and inefficient. So what we're seeing now, according to the Chainalysis reports, is the digitization of that mattress.
The arbolitos.
Yeah, the little trees. Those street money changers famous in Buenos Aires who used to swap cash, they've gone digital.
The data shows that 60% of all crypto volume in Argentina is now just stablecoins. USDT, USDC. We're not talking about people gambling on the latest meme coin here.
No, not at all. This is purely defensive. It's a synthetic savings account. You get paid in pesos, and within minutes, you swap into a digital dollar. You use it for groceries, for rent, for everything. It's functional.
But it goes even deeper than just safety. The reports highlight something they call the rouleau strategy.
The loop.
I want to drill down on this. The rouleau. It sounds like a dance move, but it's actually a form of arbitrage.
It's sophisticated market behavior at a retail level. So in Argentina, you often have this big gap between the official government exchange rate for the peso and the parallel or black market rate, blue dollar.
Right. So the government says a dollar costs, say, 1,000 pesos, but on the street it's really 1,200.
Precisely. So the rouleau, the loop works like this. Traders buy dollars at that official rate, which is artificially cheap. They then use those dollars to buy stablecoins.
Okay.
Then they sell those stablecoins back into pesos, but at the higher parallel market rate.
And the spread between those two rates is their profit.
Yep. The reports say they're making up to 4% profit per transaction, just for moving money in a circle.
That is incredible. It's basically exploiting the inefficiency of the government's own monetary policy. But it just highlights the irony we started with.
It's a huge irony.
The political rhetoric in the global south might be down with the dollar, but the people are voting with their wallets. They are hyper-dollarizing.
They're bypassing the Federal Reserve's banking system, the rails, but they're increasing demand for the dollar asset itself. It's a critical distinction. They love the software, they just hate the hardware.
That is a perfect way to put it. They want the stability of the currency without the oversight of the U.S. banking system. And just to be clear, the sources say this isn't just an Argentina thing.
No, not at all. We see it in Venezuela, where stablecoins are powering a whole parallel economy amid 229% inflation.
Yeah.
You see it in Bolivia, where shops are openly listing prices in USDT. The dollar isn't dying in these places, it's just migrating to the blockchain.
Okay, so that's the view from the street. That's survival mode. Let's zoom out and move up the food chain to the billionaires and the sovereign wealth funds. Let's talk about the UAE.
The institutional lab. Yeah. If Argentina is about survival, the UAE is about long-term geopolitical strategy.
The data point that just jumped out at me from the 2025 filings was about the Abu Dhabi Investment Council, ADS. This is a massive player.
One of the largest sovereign wealth funds on the planet, yeah.
They tripled their stake in BlackRock's Bitcoin ETF. They're holding nearly 8 million shares, valued at over $500 million. Now, sovereign wealth funds are usually pretty conservative.
Right, extremely. They like government bonds, blue chip stocks, real estate, low volatility, steady yield.
So for them to do this, it signals a pretty profound shift in mindset.
It does. They are explicitly viewing Bitcoin as digital gold. They're treating it as a strategic, neutral asset to sit right alongside their traditional reserves.
But why the UAE specifically? Is it just because they have all that excess capital from oil?
The capital is part of it for sure,
Yeah.
But it's really about building a regulatory moat. The sources detail how Dubai's VARI and Abu Dhabi's ADGM created these very specific, very clear legal frameworks.
VARA being the Virtual Assets Regulatory Authority.
Correct. And think about the contrast with the U.S. over the last few years. There's been regulation by enforcement.
Chaos. Lawsuits and confusion.
Exactly. The UAE said, here are the rules. They are strict, but they are clear. They're not banning it, but they aren't letting it run wild like a casino. They're regulating it like it's high finance.
Plus, zero personal income tax and VAT exemptions on crypto transfers. That has to help attract talent.
It brings the talent, but if you connect this to the bigger picture, the UAE is positioning itself as a digital bridge. They want to be the neutral hub where Western institutional capital, like BlackRock, can operate right alongside Eastern technology.
They're hedging their bets.
Completely. They're buying American ETFs, but as we're about to see, they're also deeply involved in China's digital currency projects. They're insulating themselves against the weaponization of Western finance.
So no matter which way the geopolitical winds blow.
Their financial pipes stay open.
And that brings us to the third lab, the geopolitical stage. This is where the story shifts from savings and investment to actual warfare. But instead of missiles, it's code.
It's the plumbing war.
To understand this, we have to talk about Project Enbridge. I think a lot of people hear CBDC or central bank digital currency and their eyes just glaze over.
Sounds bureaucratic and boring.
But Enbridge is different.
It is. It's a multi-central bank digital currency platform. It involves the central banks of China, the UAE, Thailand, and Hong Kong. It's a collaborative effort.
So what makes it a threat to the current system? Why does Washington care if Thailand and the UAE have a shared ledger?
To get the threat, you have to understand how money moves today. If the UAE wants to sell oil to Thailand right now, they almost always have to use the SWIFT system.
Which is basically a messaging app for banks.
Exactly. SWIFT doesn't move money. It just sends the message to move the money. And crucially, that money usually has to route through a U.S. correspondent bank in New York to get cleared.
And that gives the U.S. government visibility
and veto power over that transaction. That's the mechanic of sanctions. The U.S. can just tell the bank in New York, don't clear that check.
Right.
Enbridge removes that middleman. It allows the UAE and China, or Thailand, to settle trade directly on a shared ledger. No U.S. correspondent bank. No SWIFT.
So it's like handing cash directly to someone, but digitally and across borders.
Yes. And the sources mention a huge milestone in late 2025. The UAE and China completed their first cross-border CBDC transaction on a platform that connects to Enbridge.
And this made the BIS, the Bank for International Settlements, pretty nervous, didn't it?
Very nervous. The BIS, the Central Bank of Central Banks, actually discussed pulling out of the project because of the geopolitical heat. They realized this tech wasn't just about faster payments. It was being designed specifically to bypass Western sanctions. It destroys U.S. leverage.
So the U.S. isn't just going to sit there and watch SWIFT become obsolete. What's the response? The reports mention the Genius Act.
This is where the U.S. strategy gets really fascinating. The Genius Act, Guiding and Establishing National Innovation for U.S. Stablecoins Act, was passed in July 2025.
Washington loves a good acronym.
Always. On the surface, this just looks like consumer protection. It says if you issue a stablecoin, you have to back it one-to-one with U.S. dollars and short-term treasuries.
Which seems reasonable. If I hold a digital dollar, I want to know there's a real dollar behind it.
But look at the macro strategy underneath. If the U.S. government realizes it can't stop crypto, and it can't stop people in the global south from wanting dollars, it decides to co-opt the movement by forcing stablecoin issuers to buy U.S. treasuries.
Wait.
They are effectively turning the crypto market into a massive, automated buyer of U.S. government debt.
Let me connect the dots here. So every time someone in Argentina buys a USDT to hide their savings from their local government,
The issuer of that USDT gets that fiat currency and is legally required to go out and buy a U.S. Treasury bond to back it.
so the grandmother in Buenos Aires hiding money under her digital mattress is inadvertently funding the U.S. national debt.
You absolutely nailed it. You have created a new machine to finance the U.S. government using the capital of people who are trying to escape their own failing currencies.
That is diabolically brilliant.
It is. Some of the experts in our source stack argue that stablecoins are the new Eurodollars.
Can you break that down? Eurodollars is one of those terms that confuses people.
Sure. Back in the 50s and 60s, Eurodollars were just U.S. dollars held in banks outside the U.S., mostly London. They were crucial because they extended American financial power globally into places U.S. banks didn't directly control.
Okay.
Stablecoins do the exact same thing, but digitally. They extend U.S. financial power into digital wallets in Nigeria, Vietnam, Brazil, places where U.S. banks have no physical branches and no desire to open them.
So even as these governments are screaming about de-dollarization and joining BRICS, their own people are locking themselves deeper into the dollar system.
That is the paradox. The governments want out, but the people want in. And the U.S. government found a way to monetize that demand.
So if we look at the landscape in 2026 and beyond, where does this all go? Is it a winner-take-all scenario?
The sources suggest we're moving toward a bifurcation, two distinct tracks running parallel to each other.
Track one is the U.S. track.
Yes. The U.S. track is built on privately issued stablecoins, USDT. USDC, regulated by things like the Genius Act, used by retail users, by traders, and it reinforces dollar dominance. This is the internet's dollar.
And track two?
The sovereign track,
Yeah.
state-run. These are the CBDCs, like the digital yuan and Enbridge. These will be used for high-level commodities, trade oil, gas, heavy industry, specifically to bypass U.S. sanctions.
So the verdict on de-dollarization it's complicated.
The verdict is that the dollar isn't dying. It still makes up 57% of global reserves. Now, that's down from 72%, sure, but it's nowhere near dead. But the monopoly is ending. We are moving toward a multipolar currency order where the dollar is dominant but not exclusive.
That feels like a very precarious balance.
It is. It's a world where you might buy your coffee with a digital dollar, but your government buys its oil with a digital yuan. And those two systems might not even touch.
Okay, let's recap this journey because we've covered a massive amount of ground. We started in the streets of Buenos Aires.
Where the failure of the local currency forced a grassroots adoption of digital dollars just for survival.
Then we moved to the boardrooms of Abu Dhabi.
Where sovereign wealth funds realize they need neutral assets like Bitcoin and neutral jurisdictions to act as bridges between East and West.
And finally, we saw the U.S. government formalizing stablecoins to turn them into a new funding mechanism for its debt, while China tries to build a totally separate plumbing system for trade.
It's a complete rewiring of the global financial system, shifting from a centralized hub-and-spoke model centered on New York to a decentralized network with multiple nodes.
So for you listening in, maybe you're an investor, maybe you just follow geopolitics. What's the so what here? Why should you care about this plumbing?
Because for the sophisticated investor, the crypto conversation is no longer about speculation. It's not about whether Bitcoin goes to 100K or zero next week. It's about infrastructure.
It's about the pipes.
Exactly. The opportunities now lie in tokenization, in cross-border payment rails, in the compliance layers that let these two systems talk to each other. The assets that bridge the gap, like Bitcoin and compliant stablecoins, they're becoming institutional grade.
It's not just magic internet money anymore. It is the new architecture of global trade.
Precisely. And if you're ignoring the infrastructure, you're missing the biggest shift in finance since the creation of SWIFT in the 1970s.
I want to leave everyone with a final thought on this, something to chew on. We talked about how the U.S. is essentially co-opting stablecoins to buy its own debt.
Right.
And we know that citizens of rival nations, countries that might be politically hostile to the U.S., are the ones devouring these stablecoins to save their wealth. So if the U.S. government relies on private issuers to buy its debt, and the citizens of its enemies are the primary customers of those issuers, who is actually controlling whom?
That's the billion-dollar question.
Is this the end of the dollar's hegemony, or is it the beginning of the dollar transforming into something even more pervasive? The internet's dollar.
It might be that in trying to escape the dollar, the world is actually building a permanent home for it in every single smartphone on Earth.
A fascinating dilemma. Thanks for diving deep with us today.
Pleasure as always.